Chevron is on a transformative path, investing heavily in renewables while managing rising debt and tightening cash flows. Will this bold move enhance shareholder value or undermine it? Join us as we examine Chevron's financials to uncover insights that could reshape your investment outlook. Ready? Let's begin. Chevron Corporation is a global energy company involved in every aspect of the oil and gas industry, from exploration to refining. Its integrated operations may provide stability amid market volatility, offering potential opportunities for value investors seeking exposure to long-term energy demand. Examining Chevron's balance sheet reveals key shifts in its financial position. Over recent quarters, the company's cash reserves declined from $8.5 billion at the end of 2023 to $4.7 billion in September 2024. This decrease is mainly due to significant capital expenditures and $21.9 billion in stock buybacks as part of a $75 billion repurchase program. Meanwhile, total debt increased to $25.8 billion, leading to a debt-to-equity ratio of 0.17. This ratio measures the company's financial leverage, indicating modest borrowing compared to its equity. While returning value to shareholders, the rise in debt and reduction in cash may affect liquidity. Investors should consider how fluctuating oil prices could impact Chevron's ability to manage its capital structure effectively. Here's a screenshot of the full balance sheet. Notably, total assets have slightly decreased from December 2023, driven mainly by reductions in cash and accounts receivable. This might suggest tighter cash flow management, highlighting a potential risk if operational cash needs rise unexpectedly. Chevron's gross margin has remained steady between 29% and 31% through Q3 2024, showing consistent efficiency in managing production costs. However, the net income margin has declined from 11.8% in Q1 to 9.2% in Q3, suggesting that increased operating expenses and lower margins on refined products are impacting profitability. Earnings per share have been volatile, affected by lower oil prices and unfavorable currency movements. While management plans to cut structural costs by $3 billion by 2026, it's crucial to monitor how these measures will address the current margin pressures. A sustained improvement in net income margin is essential for long-term value. Here's a screenshot of the full income statement. Notably, despite a decrease in revenue, operating expenses remained fairly constant, suggesting potential inefficiencies. Net income dropped significantly, indicating challenges in cost management. For value investors, this signals a critical need to evaluate Chevron's expense control measures compared to industry peers to gauge future profitability potential. Chevron's revenue has remained steady around $49 billion over the past 4 quarters. Net income, however, has nearly doubled from $2.3 billion at the end of 2023 to $4.5 billion by September 2024. This suggests improved operational efficiency, achieving more profit from the same revenue. In an industry with volatile oil prices, reducing costs without cutting production is crucial. Chevron's focus on cost optimization, streamlining processes, and eliminating waste is paying off. While flat revenue may signal limited growth opportunities, the enhanced profitability indicates strong management. For value investors, stable revenues with rising net income signal a resilient and efficient company. Chevron's free cash flow has tightened slightly to $6.9 billion in Q3 2024, down from $7.5 billion at the end of 2023. This dip reflects increased capital expenditures in upstream projects, a strategic move to address oil demand volatility and regulatory shifts. While the free cash flow yield remains strong at 8.5%, indicating efficient cash generation relative to market value, the capex margin has risen to nearly 76%. This high level of reinvestment requires careful management to ensure cash flows can sustain shareholder returns like dividends and buybacks. Monitoring how Chevron balances these investments with cash flow preservation will be crucial for value investors. Here's a screenshot of the full cash flow statement. Notably, Chevron's net cash from operating activities remains robust, supporting heavy capital expenditures. However, the decrease in net income signals potential profitability challenges that need monitoring. For value investors, understanding Chevron's strategic cash allocations will be crucial in assessing the sustainability of its returns amid market pressures. Analysts expect Chevron's net income and earnings per share a key profitability metric, to grow significantly over the next 4 years. This optimism stems from Chevron's strategic shift toward lower carbon technologies and cost-saving measures. While these forecasts indicate potential for increased profitability, investors should consider risks like market volatility due to geopolitical factors and environmental regulations. Comparing these projections with industry peers could offer additional insight into Chevron's competitive standing and the realism of these expectations. In the latest earnings call, Chevron reported a significant increase in net income, driven by higher oil prices and effective cost control measures. Revenue growth was strong, indicating robust demand in the energy sector. However, capital expenditures also rose, reflecting substantial investments in new projects. This increase in spending could impact free cash flow, which is important for funding dividends and reducing debt. Interestingly, Chevron is expanding its investments in renewable energy, signaling a strategic move to diversify its portfolio. While this may offer long-term growth opportunities, it could affect short-term profitability. Management also highlighted challenges such as regulatory pressures and market volatility. As value investors, it's crucial to evaluate whether Chevron's intrinsic value aligns with its current market price, considering these factors. Comparing Chevron's market ratios to its peers reveals important insights. The price-to-earnings ratio indicates how much investors are willing to pay for $1 of earnings. Chevron's PA ratio is 13.1 higher than BP's 7.0 and Shell's 11.5. Similarly, the price-to-book ratio, comparing market price to book value, is 1.7 for Chevron, exceeding many competitors. These higher ratios suggest Chevron is valued at a premium, possibly due to its investments in low-carbon initiatives and efficiency improvements. For value investors seeking undervalued stocks, Chevron may appear less attractive compared to peers with lower ratios. However, its focus on sustainable energy could position it well for long-term growth. Investors should consider if the premium valuation aligns with Chevron's future prospects. Examining Chevron's discounted cash flow valuation across different scenarios sheds light on its potential path. In the base case, the share value remains steady around $272 through 2028, signaling strong operations and market adaptability. If Chevron's lower carbon technology ventures succeed, the optimistic valuation climbs to about $326 per share, highlighting growth in sustainable energy. On the other hand, the pessimistic scenario drops to approximately $217 per share due to geopolitical and regulatory risks. These projections underscore how Chevron's strategic decisions and external factors might influence its valuation, offering valuable insights for investors assessing long-term potential and risks. Analysts project Chevron stock to range between $138 and $200 over the next year, with an average target of $170. This broad forecast reflects market uncertainty, but also highlights potential growth due to Chevron's investments in energy transition and cost management. The wide range suggests that Chevron's performance may be more sensitive to industry changes compared to competitors. Understanding these projections helps investors assess how the company's strategic choices could impact its resilience and growth amid evolving energy markets. Chevron's strategic pivot toward renewable energy presents both opportunities and challenges for value investors. While its investments may position the company favorably for long-term growth in a transitioning energy market, they come with increased capital expenditures and pressure on short-term profitability. The company's premium valuation ratios reflect market optimism, but heighten the need for successful execution of its lower carbon initiatives. Operational efficiency gains and robust free cash flow offer resilience, yet rising debt and potential margin pressures warrant caution. Ultimately, Chevron's ability to balance immediate financial health with its ambitious renewable agenda will determine whether this strategic move enhances or risks shareholder value. Make sure to watch another video from our Value Explorer series by clicking the playlist below.